Hey everyone! Welcome back to Your Money Your Way. Looking for long-term value in the Singapore stock market? Ever wondered what it means when a stock hits its 52-week high? Today, we're diving into 3 Singaporean giants. Recently, they hitting 52 weeks high. Are they still good long-term buys after such a run? Stick around as we break down their performance, strategies, and what you need to know before considering them for your portfolio. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Why even look at stocks hitting 52-week highs? Well, it often signals strong positive momentum, maybe due to great earnings or exciting news. It tells us investors are confident. But, and this is a big but, a high price today doesn't automatically mean it's a great long-term investment. It's a starting point for deeper research, not a blind buy signal. So, what makes a good long-term investment? Here are some quick golden rules. Think long-term. Years, even decades. This helps you ride out market ups and downs and lets the magic of compounding work for you. Know your risk tolerance. How much volatility can you stomach? Your investments should match your comfort level and financial capacity to handle potential dips. Dig into fundamentals. Look at the company's health, its earnings per share, how efficiently it uses shareholder money, return on equity, its valuation, like the P/E ratio, debt levels, and cash flow. Is it profitable and stable? Check out management. Is the leadership team experienced? Do they have a clear strategy? Do they invest their own money in the company? Good leaders make a huge difference. Diversify. Don't put all your eggs in one basket. Spreading investments across different assets and sectors helps manage risk. Keep these principles in mind as we look at our 3 stocks. First, let's talk about Singapore Exchange. SGX is essentially the engine room of Singapore's financial market. It's the only stock exchange operator. They handle listings, trading, clearing across equities, bonds, derivatives, and more. A big plus is their international reach. Recently, SGX hit a 52-week high around 14 Singapore dollars and 80 cents, trading at 14 Singapore dollars and 40 cents as of early May 2025. This comes off strong financial performance. For the first half of its fiscal year 2025, revenue jumped over 15% to 646 million Singapore dollars, and net profit surged by more than 27% to 320 million Singapore dollars. They're also consistent with dividends, currently yielding around 2.5%, and aim for steady dividend growth. Strategically, SGX is expanding its offerings, like Singapore Depository Receipts, SDRs, and attracting more international brokers and investors. Their derivatives and FX businesses are key growth drivers. The risks. Market downturns can hit trading volumes. There's competition from other exchanges like HKEX, and some analysts feel its current high valuation might limit immediate upside. Long-term, SGX offers stability, income, and moderate growth, being a critical piece of Asia's financial infrastructure. It's one for investors who like a solid, defensive play. Next one, ST Engineering, a global giant in technology, defense, and engineering. Think aerospace MRO, that's maintenance, repair, and overhaul, smart city solutions, and cutting-edge defense systems. A key point, Temasek Holdings is a major shareholder. ST Engineering stock has been on a tear, hitting a 52-week high near 7 Singapore dollars and 50 cents, trading around 7 Singapore dollars and 51 cents in early May 2025. That's a massive jump of over 96% in the past year. This is backed by stellar financials. For 2024, revenue hit 11.3 billion Singapore dollars, up 12%, and net profit climbed nearly 20% to 702 million Singapore dollars. But the real showstopper, their order book. A whopping 28.5 billion Singapore dollars at the end of 2024. This means they have a lot of future business already locked in. They also have a progressive dividend policy, aiming for 18 cents per share in 2025 and planning to share profit increases with shareholders. Current yield is around 2.2%. Strategically, they're targeting 17 billion Singapore dollars in revenue by 2029, focusing on digital business, smart mobility, and premier MRO. Geopolitical tensions are also, frankly, a tailwind for their defense arm. The main caution: its POE ratio is quite high, around 33 to 37, meaning a lot of this good news might already be baked into the price. For long-term investors, ST Engineering offers strong growth potential tied to global tech and defense trends, plus rising income. It's a quality company, but the current valuation needs careful thought. Third one, Singapore Telecommunications, Singtel. Singtel is more than just your local telco. It's a major communications technology group across Singapore and Australia through Optus, with significant stakes in regional mobile operators in India, Indonesia, and Thailand. Singtel also hit its 52-week high, around 3 Singapore dollars and 90 cents, trading there in early May 2025. That's a near 63% rise over the past year. This reflects growing confidence in its ST28 transformation plan. For the first 9 months of fiscal 2025, underlying net profit rose over 11% to 1.9 billion Singapore dollars. A key attraction is its dividend, guided around 0.165 Singapore dollars for FY25, yielding about 4.2%, plus potential value realization dividends from asset sales. The ST28 plan is crucial. Singtel aims to unlock 6 billion Singapore dollars by monetising assets, funding growth in areas like 5G enterprise solutions, its tech services arm NCS, and its data center business, Engzara. A turnaround at Optus is also key. Risks include intense competition in core markets, execution of the ST28 plan, and performance of its regional associates. Singtel is a transformation story. It offers high income potential and exposure to emerging market growth. If ST28 succeeds, there's significant upside, but it comes with the risks of a major overhaul. So, to quickly recap, Singapore Exchange offers stability and steady income from its core financial infrastructure role. ST Engineering is your growth play, fueled by a massive order book and global tech trends, but with a premium valuation. Singtel is a transformation in progress, offering a high yield and digital growth potential, but with execution risks. All three are blue-chip companies showing strong recent momentum. But remember, hitting a 52-week high is just one piece of the puzzle. Before making any investment decisions, always do your own thorough research. Consider your personal financial goals, your investment timeline, and your risk tolerance. What's right for one investor might not be right for you. Thanks for watching. If you found this helpful, give us a like, subscribe for more investing insights, and let us know in the comments which Singapore stocks you're watching.